So what do we have to do discounted cash flows? What piece of information do you want? And when we do this problem, same thing. This isn't really a problem. This is value of business. Well, I guess that's a problem. I'd like to know how much it's worth before I buy it. I'm going to make my own independent estimate of what the stock is worth. I know what the stock market thinks it's worth. It's whatever it traded for in the last trade. Right, guys? Whatever it's trading for is what it's worth. You can look up the value of any publicly traded company right now. Right? Well, a half hour after that trade. You should get it for free. If you want to pay money, you can get a service that will tell you what it traded for right now. Real time. Right? I give it to you. You have to pay for that. Okay? But what good is that to you? Do you really care how much you pay for an asset, or do you care how much the difference is between what you pay for it and what you sell it for? I care what the change is going to be in the future. I'm predicting the future here when I buy stock, right? It's going to go up. Otherwise, I don't want to buy it. Right, guys? Okay, so here's an independent estimate of what any stock is worth. You can do this. You can do it for a privately held company, too. Right? You just have to make more of the estimates. The market isn't doing it for you. Okay? All right, so anyway, what do you need to know to do discounted cash flows? If you wanted to calculate, what are you calculating anyway? What are we calculating here? The value of something right now is called, present value times 0. That's what we are calculating. That's the whole task. Big deal. Okay? What pieces of information do you have to know for that?
Are we supposed to be able to see something up there because that's not on?
Oh. It didn't turn on. It was on a little while ago. And the other group was in here and it turned it off. On. And that might have done something. See, it's flashing. Yeah, you're supposed to be able to see something. Okay, I wrote down TB equals question mark. Okay, that's what we're solving for here, right? The value of the stock. What do you need to know to calculate a present value? What things?
Interest rate.
Interest rate. Okay. What are we going to use for the interest rate here? We are calculating the rate that we must earn on our assets in order to keep the debt holders happy and the shareholders happy. What do you call that? What is it? What do we use to discount all those future cash flows that we're going to estimate here? That's what weighted average cost of capital is. It's the cost of my capital. Got it? And my capital is really my debt, my equity both. Okay, so if you think about it, assets equal liabilities plus equity. The weighted average cost of capital is the cost of those assets. What percent do I have to earn on my assets so I can keep my debt holders happy and so I can keep my equity holders happy? Right? So if stock has a particular value, it has that value because it has a particular future cash flow and it has a particular earnings rate, which has to be the weighted average cost of capital. And that's the theory with this thing. Okay, so yeah, an interest rate. What else do we need? Present value, interest rate. We're going to calculate present value. We need the interest rate. What else do we need? Come on, you guys, you just did present value calculations for me. What else do you need? A what? Number of periods. Okay. All right. This is a good one. I'm not very good with that sign. I'm not very good with any sign. That's not a bow. That's infinity. Okay? To infinity. When you buy a share of stock, you are buying all their cash flows forever. Now, I know you're not going to live forever. You're not going to get all their cash flows forever. But here's the deal. Think about this. When I buy a share of stock, I'm buying the discounted present value of all their cash flows today for the life of the company. And we think in perpetuity, right? For most companies, we don't know when they're going to go broke, if they're going to go broke, right? So we think they're going to last forever. They don't have to last forever, by the way. Because at a very high discount rate, cash flows 20 years from now, how much are they worth? Say 12% 20 years from now. How much is that worth? Penny? Right? You guys know this, right? What if it's 40 years? Nothing. What if it's 100 years? Absolutely nothing, right? I mean, it's a little tiny number. Right, guys? You guys know this from doing these present values. Okay, so what we really worry about is the next 5 years to 10 years, right? Depending on how big your discount rate is. Does that make sense? Which, by discount rate, I mean how big your WACC is. So it's to infinity. So we think the cash flows are to infinity. Okay, and we need one other thing. We're not going to know the future value. If I use the future value, I wouldn't do this calculation. Not really. If I use the future value of the stock, if I had a crystal ball, I wouldn't tell anybody, right? I know the stock's going to be worth in the future. No. Okay, so we're trying to estimate what it's worth now. Okay, which is the discounted present value of all future cash flows. Wonderful. Okay, so that's forever. Everybody got the idea? We're going to discount those cash flows forever. So what else do I need? I'm not going to have a future value of the sum, so what am I going to probably have otherwise? Well, come on, you guys. What's the other piece that you could do to calculate a present value? If you don't have a future value of the sum, if you had the interest rate, right, and you had the number of periods, and you want to calculate the present value, right, what other thing would allow you to do that? A payment. Excellent. And it's going to be an annuity payment. Okay? There's a lot of assumptions in this. Assuming cash flows forever, for instance, right? We're going to make all kinds of assumptions in this process. Just coming up with our own estimate here, right? But the market has to be making assumptions too, right? Everybody always says, oh, well, a share of stock's worth whatever it's selling for. That is absolutely worthless. You want to know what it's selling for? Later, not now. What should it be selling for compared to what it's selling for? You like that? What do you think it should be selling for more than it's selling for? Buy it. What do you think it should be selling for less than it's selling for? If you're holding it, sell it. If you're not holding it, what should you do? Well, certainly don't buy it, but what can you do? You can go short. What does that mean?
You put money that it's going to go down.
You place a bet with options that it's going to go down. Basically is what happens, right? What you do is you wait, you agree to sell it to somebody at maybe the current price, right, that kind of thing, out in the future. And then you wait for the price to go down, and then you buy it, and immediately you sell it, and you exercise your option, and you make the gain. Oh, but what happens if it goes up in value? Now you have to pay more for it, sell it for less, and you immediately lose. It's gambling. It's really risky. A lot of people do this. It's okay. There's nothing wrong with options. Okay, as long as you know what kind of risk pattern you're getting into. We'll talk about that in 313 a lot, values. Okay, look at it. And certainly in finance, upper division finance classes, you do that a lot. Okay? Do a little bit of it in finance 315, but in the higher level finance classes, you do more of it. And in an MBA program, you do more of it, whatever, Master's of Finance. Okay, so this is going to be an annuity payment. Now, we assume it's an ordinary annuity payment because we don't really know when the cash flows are going to come in, but it's probably an ordinary annuity anyway. And it doesn't really matter because we're not going to be using tables anyway, but it's kind of, we think the cash flows at the end of the period. Okay? One other thing. So this is an annuity payment. Well, how much is the annuity payment? What does a stock give you? What does a company generate? Think about doing a cash flow statement. What does a company generate in terms of cash? How do you do a cash flow statement? You start with operations, right? And that's what we're going to value is the operations, not the investment. It's investment financing. Okay? We're going to value the operations here. Right? Because that's the cash flow you're generating from operating business. That's what you're buying when you buy the stock. Right? So how do you do a cash flow statement? What do we start with? Operating section of cash flow statement. Net income. Yeah. And then what do? We adjust it for depreciation, amortization, gains and losses, non-cash items, changes in accounts receivable, right? Changes in current assets, changes in current liabilities. Right, guys? You remember that? Come down to the cash flow from operations. We're going to use sort of as a proxy for cash flows out into the future, the net income plus the depreciation and amortization. We'll probably just stop there, right? Okay? Because we think the changes in the current assets and current liabilities are going to be, they're just going to offset each other over time. Lots of assumptions in this. You don't have to do that. You can get more sophisticated if you want. You can predict actually what's going to happen on an ongoing basis, year after year after year. Doesn't matter. Okay? But just for kind of a quick pass at this thing, right? That's all this is. We're going to just assume that our cash flows are our net income, accrual basis net income, plus basically plus depreciation and amortization. Net of the tax impact flows. Looking at here. Okay? So that's what's going on here. Okay? Is that a pretty good estimate of cash flows? Actually, probably for most companies. Why do we add back the depreciation and amortization?
Non-cash.
It's non-cash expense. That's it. That's it. Okay? can get more sophisticated and take all your other non-cash expenses and all your other non-cash revenues, if you have any of those, that long-term deferred revenue earnings stuff. You can get more sophisticated if you want. And we'll do it this way. Okay? All right? And then trying to value the company. So this is an art, not a science, bro. Okay? So that the annuity payment is going to be our annual cash flows. That makes sense? Of course it is. Now those annual cash flows are what the whole company earns. So one share of stock, how would you get their portion of those annual cash flows?
Earnings per share?
Well, it's not just earnings per share, because you'd have to add the depreciation per share back too. So but you could take those cash flows and just divide them by outstanding shares. And that's what we'll do. Basically, that's it, okay? We're going to value each share. We'll value the whole company, right? And then we'll just divide it by the number of shares, and guess what? We got the per share estimate. You like it? It's simple, intuitive, right? This just isn't a very big deal, okay? And finding the information is not really all that hard. What's hard is figuring out, do I really believe what I'm looking at, right? Do I really believe this number after I calculate it? The calculation is going to be something, okay? Really is, okay? I got one other thing for you. On these annual cash flows, do you think cash flows are going to go up next year or down next year, or do you know? And another, on the interest rate, do you think the interest rate is going to go up next year or down next year, or do you really know? What's your best estimate of tomorrow's interest rates? Today's. You think they're going to go up? I think they might too, given the way the economy is right now, the way the situation is, and what the Fed's saying. But I thought that for the last 8 years, they were going to raise interest rates. How many times did they raise it? 0 times. Should I have placed any bets in the last 8 years that they were going to raise interest rates? Lots of people did, and they lost money, right? I don't mean it's an irrational bet, because I can't believe interest rates are so low as they are, right? At some point it's going to go. I had executive MBA students when the market was at 6,000, and I'm telling them, you know, and of course at every other level, right? But the market had just gone down from 13, was it, to 6, or to push you. Anyway, it just nailed it, right? Just came down. And the banking crisis, banking theft, right? Scandals. Anyway, you know, the subprime loans. When that market went down, all these guys were saying, well, do you think it will ever recover? Yeah. And I said, I think it's going to be 20,000 or something. You're crazy. You're a madman. And I said, well, what do you think? Do you think it's never going up again? Really? What do you think? The world's over? We're not going to have economies anymore? We're not going to produce anything? We're not going to work anymore? We're not going to try to develop anything? We're just going to give up. It's over, right? And we're going to let the market just stay at 6 for the rest of our lives. Why would we do that? Why would anybody do that? We're going to produce. We're going to do stuff. We're going to work. We're going to try hard, right? Besides, the market was irrationally low. You know what? Before the market went down from 13 to 6, every business we valued in the MBA program and in accounting 211, places I do it, right? Every single business we valued was worth less than we valued it at. They were all overvalued. I was still buying stock like a wave. Why? Because if you don't buy stock, you don't get to run up. Because it kept going up and up and up and up and up. The market was way too high for quite a while. And then when the bottom fell out, guess what? Immediately, every company you valued was what? Selling for less than it should be. And I think, well, of course it's going to bump back up. And what has it done over the last, how many years has Obama been president? 7? So 7. Okay, so 1 year left or something. Okay, 7 years, right? In the 7 years, it's tripled. The market has tripled. Is that real gain? No, it should have been probably 12 in the first place, right? So it went from 12 to 18. That's a pretty good growth for his presidency. It looks so much better though to say 6 to 18, doesn't it? If you can really brag about it, right? Well, it was an artificial drop, right? Because people panic. When people panic, the market goes down. When people get overly optimistic, what happens? The market goes up. Here's the rub. You don't know what's going to happen next, though, do you? What's the next thing that's going to happen? And that's the game. That's the game. If you can guess when the bottom's going to fall out, you can get really rich. Because you can place a bet that the bottom's going to fall out. You win, right? And some people really make a lot of money out of the big drop in the stock market. Maybe you don't get to win at the casino unless you actually put your money down, right? But by the way, don't go to the casino, bet on the market crashing. You want to take a long shot at that, right? Why not? Or bet on it taking off. Will the market double the next year? It's going to go from 18 to 30, it's 18,000 points, right? The Dow Jones, 18,000. You think it'll go to 36 next year? I don't know. If it does, I'm going to be real happy because I have some money in the market, right? I don't think it will. I'm certainly not going to take all my money and place a bet, right? Not going to do it. Might it go up by 12% next year? Yeah, probably. That's my best guess. You know why that's my best guess? No, this year was far more. Last year was far more because remember it was real low and things you have to bump it back up. So it was a lot better the last number of years. But now that I think the market's probably maybe a tiny bit overpriced, but maybe about right. I don't know. I don't know, right? Well, just look at the last 30, 40 years for us, right? Maybe it's about where it should be. Mike McKay is better. Because no one who Mike McKay is, there's a lot of investing in the investing club. And he's kept track of, he's a faculty member here. He's kept track of the growth in the market over the last 40 years. And he's got a line predicting where the market will be in another 10 years. So you can talk to him about that. And so he wasn't at all surprised when the market went way down. He thought it was too low too. And then, you know, he's not surprised by it going back up. But I think he'd probably say, yeah, we're there, right? We're there. If we do get a big bump up in the next year, it's probably irrational. He was just too excited about things. Takes off. But Dan, would you quit buying stock because the market takes off? You don't dare. You don't know how long it's going to stay irrational. Right? Because I bought stock, you know, maybe the market was at 8, and now it's at 18. You know what I mean? And I paid too much when it was 8, but now it's 18, you guys. And if I hadn't bought it, then maybe it should be 18. Now here's the deal. How much do you earn on a risk-free investment? Yes, no? 6%. A 30-year bond is what I like as a proxy. I won that argument with my co-authors there. Okay, I like a 30-year bond because I think we're investing forever in the company. We're not really. We're just buying all their cash flows forever. By the way, when I buy the stock, I have to pay for all their cash flows forever. Just kind of back in that. And then when I sell it, what do I sell it for? All the cash flows forever. Get it? What do you get to keep? What happens in between, right? You get the cash flows while you held it. That's it. Okay? What if they don't pay you in dividends? It's okay. You get them in stock appreciation. What if they do give them to you in dividends? There's less stock appreciation. I don't care if I get dividends or I get stock appreciation as long as I don't have to pay tax on it, right? So all my investments are set up, right? So that if I get a dividend, it doesn't come to me. It's reinvested, and I don't have to pay tax on it. Now, pay tax on the tax. Okay? Right? So I don't care if you give me a dividend or not. I don't want the dividend personally. Why not? One, I'd have to pay tax on it. Two, I'd have to find someplace to invest it. It's annoying. If they have a good investment, right? Good things to invest it in, companies I'm already invested in, what do I want them to do? If they can keep making that weighted average cost of capital that I like, that's why I like that company, right? What do we want them to do? If they have more investments, they can grow. Grow. Keep earning it, right? By the way, what if I wanted to earn more than that? They have to take more risk. Risk return. You're only really going to get more return if you take more risk. Okay? You can be guaranteed that 2 to 3% return. Is it around 3 something on a 30-year bond right now? Around 3, between 3 and 4 maybe. Okay? You can earn 3 to 4% without taking any risk. Better savings account, right? Okay, so you can't invest enough money, you can buy government securities. So you make that kind of money. How much additional can you get into going to the market? 5, 6, 7, 8 different people have different estimates. Wow. Are you willing to take risks? You want to have any wealth? You got to learn to take risks. 100% of my money is in the stock market, except for what's in my wallet, which is about $40. Everything. I'm not dying anytime soon. If I do, who cares? I'll use the money anyway. Right? Most likely I'm going to live a long time. I kind of like to be able to retire someday and live well. we did that little thing on the quiz of how much do you need to invest in your retirement, you know, and what kind of payoff would you get. This is the same deal. It's the same deal. It's what people are trying to do. Okay, anyway. So what's your best guess of next year's interest rates? Probably this year's. What's your best guess of annual cash flows next year? Well, you know what? It might be this year's, but you might think the company's going to grow. And if you think the company's going to grow, you can add a growth factor to this. It's built into the formula, even the simple one that we're going to do here. What do you think the company's declining? They're in a declining industry, or they're a company that's declining within the industry? Now what? You have negative growth. You use exactly the same growth formula, right? But you just make it negative. I think their cash flows are going to go down 1% a year, right? Forever, until they don't exist anymore, or 2%. Or I think they're going to go up 2% a year. So we can factor growth into it too. It's no big deal, okay? So all this looks really formula-driven, but what I'd like you to do is get it common sense, and that's why we wrote this little paper, right? It's supposed to try to break it down into common sense for you. Okay, so your estimate of cash flows is going to be based on what? Income now, okay? Basically, that's it. Oh, by the way, why do we use accrual basis income? Because we think it's a better measure of future revenues and future expenses, right? A more realistic estimate of what's going to happen than cash flows are, okay? And then we'll adjust it for the depreciation. Okay, good. So let's give this a shot. Let's try it. How would you do this thing? How does the formula work? What is the value of a company? If I wanted to know over here, my estimate of the market value per share, what do I start with? Yeah, estimated cash flows. That's it. If I had my estimated cash flows, that's an annuity, guys, okay? Estimated cash flows. And then what am I going to do with it?
Divide by your interest rate.
Okay, which is what?
The WAC.
Yeah, whack. Okay? She just got here. Lovely out there, huh? Back with a long ways.
What's that?
How long were you in traffic?
Hour and 10.
Was it really a shooting?
I don't know. I couldn't get. I mean, I wasn't close enough.
Yeah,
Where
I mean,
were you at? We were on 71. 71.
It was
Coming
a
into Louisville.
There's shooting on 71.
yeah, there's the pictures on Wave 3 now. I was just looking at it. The blackish Lexus SUV connected to the big bench on the side window.
I'm not surprised. It's like Ben Hur out there on that interstate. It really is. It's just, I had somebody throw something at my car the other day.
Anyway, estimated cash flows, that's awful. Estimated cash flows divided by the weighted average cost of capital will give me what? You guys, this is an annuity. Everybody got it? Forever. And then I divide it by the weighted average cost of capital, right? And what that's going to give me is an estimate of what? The market value of the assets. No kidding. To the company. Okay. No kidding. Subtract from that your estimate of the market value of the liabilities. And what are you going to have? You know, assets less liabilities, guys?
Equity.
Estimated market value of the equity. No kidding. Does this just make simple sense? What do you think? Would all that just kind of make sense to you guys? So far, the estimated cash flows divided by the WACC. I'm discounting by the WACC. We'll get into that a little bit here more in a second. Gives me my estimated market value of the assets. Then I subtract my estimated market value of the liabilities. Well, of course, the assets less the liabilities is the equity, right? I have an independent estimate of the market value of the equity. That's what I'm doing. What would I divide that by to get the estimate of market value per share? How about the number of what? Outstanding shares. And that's it, gang. This is a very simple model. There's not much to it. It really isn't. Okay? It's kind of intuitive if you let it be. It makes sense. Okay, now let's talk about why we're just dividing by WACC. How do you usually do present values? Usually what you would do is you would take the future value, those future cash flows, right? some period from now, and you would discount them at 1 over 1 plus the interest rate for the number of periods, and that would give you the present value. Everybody knows this, right? Future value, some number of periods from now, times 1 over 1 plus the interest rate raised the number of periods, huh? So you could put whack in there for the interest rate. You could put infinity in here, for the number of periods, right? So we're getting the same cash flow, we think, period after period after period to infinity, huh? Okay. What that breaks down to, and I'll show it to you, not mathematically, I'll show it to you logically. Those of you who get a finance master someday, or a PhD in accounting or finance, or maybe econ, you would have to do this mathematically and prove that you could. But I'll just show it to you intuitively. But how would this thing work? What this breaks down to, if you sum up all the years to infinity, right, it is the same as taking the future value, right, per period, right, that annuity payment, it's an annuity payment, and just dividing it by the interest rate, or taking it times 1 over the interest rate. It collapses to that. Because the first year is a pretty big number, right? Discount rate for 1 year out is a pretty big number. Say at 10%, it's about 91 cents, right? 0.91. And then the next one is 0.82, and the next one is 0.73. You got the idea? And you keep adding those up. Well, when you get out to infinity, of course, it's nothing, right? So it all collapses down to just taking it times 1 over the interest rate, huh? Or just dividing it by the interest rate. So this is cool. It's a neat mathematical outcome. Now let me do it for you in common sense. If that went right by you, don't worry about it. I'll do it in just plain common sense here. Okay? Here we go. Let's say that I am generating $10,000 a year in estimated cash flows, and my cost of capital is 10%. Do the calculation first. 10,000 divided by 0.1 is what? 100,000. Okay? Now let's go the other direction. Let's think about it. How much would your cash flows have to be, right? How much would your cash flows have to be? So if you knew the 100,000 of assets, and you knew you wanted to earn 10%, how much would the cash flows have to be so that you could take the 10% out, not lose any of your investment, and your investment would not grow? It'd be 10 grand, wouldn't it? Because 100,000 times 10% is 10,000, right? Remember, this is forever, right? So do you intuitively get this idea? Obviously, 10,000 received every year forever, if you're earning 10%, means you have 100,000 invested, doesn't it? Does everybody see that? Or you could say, I know the 10,000, right? And I know the 100,000. How much am I earning every year if I'm taking 10,000 out every year? 10%. It's forever, you guys. It's an annuity forever. Got it? So does this make sense that you would take whatever your estimate of cash flows is and divide it by whatever your WACC is, and you would get what the assets have to be worth? Okay? The WACC is how much I'm going to earn on all of my assets, whether I borrowed the money, it'd be debt, or it's equity. Everybody good? That's the trick, okay? To getting this down, other than just doing it mechanically. At first you're going to do it kind of mechanically, and then you're going to say, oh, that's cool, that makes sense, that makes sense, that makes sense. And then it gets easy, okay? It gets really easy. Okay, good. Well, then let's talk about where these pieces come from. If I knew the estimated cash flows, I could divide them by the WACC, and I could just keep going, huh? And here's the value I really want. I really want to know my own independent estimate of market value per share. I don't want that thing. I'm going to recommend people buy stocks where I think the estimated market value per share is higher than it's selling for. I'm going to tell them not to buy stocks where I think it's lower. And everybody out there does this that knows what they're doing. You don't have somebody who say, oh, that's a really good stock, sell it to everybody. Oh, Jesus, you know, you're a salesperson, you're not a finance person, right? Okay? You know, it's like telling you, this is a good phone, sell it to somebody, and you don't know what it is, right? You just sell them whatever the product is that people have. And by the way, most people out there, I have a certain amount of disdain for the finance industry, what we call the finance industry, because they're just selling stuff and they don't know what they're selling. It drives me crazy. Don't use them. Don't have somebody else manage your money. Manage it yourself. You're going to know how, right? Okay. Now that doesn't mean you can have people do analysis for you, get information for you, and all that. That's all legitimate, right? And you can have people manage your money, but if you're going to have them manage your money, it's because you don't have time, and they do have time, and they're good at it, right? That's fine. I do that. I pay less than 1% a year to have my money managed. I don't mean 1% of my earnings. I mean 1% of my wealth I give them. And on average, they earn me 12 or 13, and I give them 1. And that's cheaper than me doing it myself, because I have to do this. And besides, I like doing this, and I don't want to do that. I make more money by working than I would by managing my portfolio. Does that make sense? That 1% of my portfolio that I give away to somebody else. But I can do it myself. I know how. I know what they're doing, right? Do I ever pay somebody 5% to buy for me and then 5% to sell for me? A fee going in and a fee going out. That's 10%. That's probably a year's earnings that they got for encouraging me to buy something and encouraging me to sell something. So if you guys go into finance, don't get paid commissions. Get paid to manage the fund. You make a lot more money anyway. And you, by the way, what if my stock portfolio goes down in value? Do I still give them 1% of my wealth? Yes. Do they make less? Yeah, because my wealth is less. But they still get paid. They're still doing their job. They're still working. They're still trying hard. The market went down. They didn't make the market go down, right? Okay. And I choose the risk level I want, right? And they just implement it. That makes sense, guys? Okay. Anyway, so here we go. Where do we get estimated cash flows? We're going to get this piece, and then everything else is going to fall out. Those are the two big ones, huh? How do you get the estimated cash flows? What's the formula?
Income from operations times 1 minus tax rate plus depreciation.
Okay. This is finance. This is the way finance guys like to do it. Income, guys, is a neuter term, right? Men and women. The finance game. Okay. Income from operations. Now, here's the deal. You don't just use income from operations. You use income you expect to continue into the future. Everybody good? Get more sophisticated than this. Don't just grab the number off of the income statement. Because some people put interest expense below income from operations. Some people put it above. There's always interest expense. I think you should take the interest expense out before you do this, right? So we're going to be a little more sophisticated. What if they have reorganization costs every single year? That's not reorganization costs. That's normal cost of doing business for them. But they put it down below in the non-operating, right? So I pick it up. Got the idea? So we're going to look a little more sophisticated at this. But it's going to be income from operations, income continuing into the future forever, right? My estimate of income is going to be forever. Times what?
1 minus tax rate.
Yeah. 1 minus the tax rate. And why are you taking out the taxes? Because you don't get to keep the taxes, right? Why don't we take income from operations after tax? Because there is no such thing. When you look at an income statement, there might be non-operating items down below, right? Before tax, right? And then there might be reorganization down below. There could be all kinds of things down below. Interest could be down there, right? And then you get net income before tax. But I don't want, on a lot of companies, I don't want the net income before tax. It's not the same as the income from operations I want to pick up. Does that make sense? So I figure out what a normal tax rate is. Plus, a particular year's tax rate might not be normal for the company. I want what the tax rate is going to be forever into the future. These incomes are forever into the future. Got the idea? So I come up with my own estimate of tax rate, what it's going to be. Okay? We're going to do that. So what I'll do is I'll take normal income continuing into the future times 1 minus the tax rate, because obviously, why is it 1 minus the tax rate? The government takes the tax rate, right? If I'm in a 30% tax bracket, the government takes 30 cents out of every dollar, and I get to keep 7. That's all that's happening there. Everybody good with that? It's true, isn't it? So it's 1 minus the tax rate. What does that give me, by the way? What is that going to be? Well, continuing after-tax income that I expect to have forever, right? And then what do I add back?
Depreciation.
Depreciation and amortization. And this one shakes people up. Why do we add it back after doing the taxes? Well, here's the deal. You get something called a depreciation tax shield. If I'm in a 30% tax bracket and I have $100,000 of depreciation, it uses no cash for the depreciation expense, right? It's debit depreciation expense, credit accumulated depreciation. Everybody staying with me? So it's using no cash, but it saves me $30,000 of taxes. Real cash flow. Right? It does, doesn't it? Because I put $100,000 on my tax return. With a 30% bracket, I save $30,000. It's called the depreciation tax shield. It's real. That's okay. You have to buy the asset, remember? Right? To get the depreciation, it's fine. Okay. So you've got the 30,000 savings. So what we do is in income from operations, we include the depreciation expense. It's already out of there because we're going to get a tax savings from it. And then we add back all the depreciation amortization. Depreciation amortization doesn't generate you any cash. It's that we took it out of income before we calculated our taxes, right? So we've got to add it all back. That's all, okay? And we'll go through these a few times, quite a few times, okay? And that's where we're going to be, everybody, right? That's it, isn't it? Now, you get fancier than this, yes?
I just want to ask a quick question about the tax rate.
Mhm.
It's getting a little bit ahead of the game, but I just wanted to know if it's the same tax rate as what you get for your cost of debt in the cost of debt calculations? Or
Yes,
is your-
I'm gonna do
Okay.
one estimate of tax rate, I'm gonna do one estimate of everything. I'm gonna do
Okay.
one estimate of liabilities, and it's the same estimate. I'm gonna do one estimate of the tax rate, I'm gonna do one estimate of the interest rate, okay, one, okay, of WAC, okay? That's a great question. Don't do a whole bunch of different estimates, it's kind of meaningless, okay? So that's estimated cash flow, so you see what we've done here, you guys? We got that one. What's the other big one? WAC, weighted average cost of capital. Man, I really wasted a lot of time today. Okay, I always do. Okay, we had several days on this. Weighted average cost of capital, what's the deal? Oh, by the way, for tomorrow, what do you want to do? What company I suggest you value? On your syllabus. Nobody looked that far ahead. I wouldn't expect you would. Is it Yum?
Yeah.
We can value Yum,
Target and Yum.
Target, value Yum and Target, right? Do it, okay? Go look them up. You guys know how to go out on the internet and find a set of financial statements? Then learn if you don't. You know how to surf the web? Type in the company name. No kidding. Go to investors on their main web page. Click on it. Open it up. Guess what? You'll find their financial statements if you look around. Okay? Figure it out. Okay? I know you guys know how to surf the web. True? You know how to find them, don't you? Yeah. Okay. It's easy, isn't it? Okay. And next time we'll do it. We'll do it together. Okay? So value them. Because I'm going to ask everybody for a value for those two companies. Okay? Want to do that? Next time I'll ask everybody. We'll go around the room and we'll write all your values on the board. And then we'll see who's close and who's not. Okay? Give it a shot. I want the value per share. Okay? That's what we're going to want. Okay? What's WAC? It's the weighted average cost of capital. What's the capital, you guys? Assets. Where does it come from? Liabilities and equity. So what do we have here, you guys? What do you think? The weighted average cost of capital, this is going to be the cost of the assets, if you want to think about it that way. The weighted average cost of capital is the amount that we have to earn on these assets to keep both the debt holders happy and the equity holders happy. What's it going to be? It's weighted, you guys, so we take the weight of what? The weight of the debt over here times what? The cost of the debt. Well, times the cost of the debt first, okay? The weight of the debt times the cost of the debt. Why do we use K? Because C is consumption for economists. So K is cost. You like it? That's why it's a K. I know K is not spelled with it, or cost isn't spelled with a K, but anyway. All right? Cost of the debt, okay? Plus, that's the weight of the debt times the cost of the debt, right? Plus what? The weight of the equity, right? Times the cost of the equity. No kidding. That's all we're going to do. And we add those together, right? That's what we need to earn on the assets. So it's the cost of this times its weight, right? Plus the cost of this times its weight will give me the weighted average cost of that one. That's it. You get it intuitively? Okay. How do we get the weights? Do not use book values. I want an estimate of the market value of the equity and an estimate of the market value of the liabilities. And when I add those two together, I have an estimate of the market value of what? Assets. You got it. So these are market value, gang. That makes sense? They're market value. How would you get an estimate of the market value of the liabilities? Well, actually, you could value them. You could take the discounted present value at the current interest rates for all your bonds and stuff, right? Value your bonds like you would at the time you issue a bond. Most people don't do that, right? It's a little bit of work, quite a bit of work, a lot of times. And usually you end up with a number that doesn't make much difference in the calculation. It's fairly close to the book value. Oh! So because the book value is fairly close to the market value for most companies, what do? As a proxy for the market value, and this is weird, as a proxy for the market value, we use the book value of the debt, okay? So as a proxy for the market value, I use the book value of the debt, okay? And that'd be the number I use for the liabilities. Make sense? Odd, but that's what we do, okay? But I can get a market value on the equity, an estimate of the market value in the equity. How would I do that? You got it. number of outstanding shares times what? The market value per share. This isn't my estimate of the market value per share, it's the market's estimate, right? What's the stock selling for? So I go look up what the stock is selling for, look up its outstanding number of shares and multiply them together. By the way, that's called the market cap. And they do it for you. They calculate it for you. If you go out to Yahoo Finance or MS Finance, you can find market capitalization, market cap they call it. All they did was they took the outstanding shares times the market value on that day. They did it for you. So you've got the total equity. So then what I do is I'd add together the equity and the liabilities and I got the total assets. Now what? Let's say it's $10 a share, or I'm sorry, 10,000 shares. Okay, it's a little tiny company. It's $10 per share, so I've got 100,000 total equity. And then let's say that I had 50,000 total liabilities. What's my total assets? 150. What would you do? I'd make the 150 100% of the assets, because it is, right? 150 divided by 150. What's my liabilities share? 33 1/3%. What's my equity? 66 2/3%. You got the idea, guys? Do those two weights have to add up to 100%? Of course. Okay? Are we good? So whatever percent of the market value, it's market value, not book value. Whatever percent of the market value, the liability of the total assets, the liabilities are, that's the percent, okay? So I got 33% here in my little example, and I have 67% maybe over here. Got the idea? Whatever it is, based on market value. Now what's the cost of the debt? What do we pay on the debt? Interest. It's my interest rate. But you know what? If I have 10% interest rate and I'm in a 30% tax bracket, Uncle Sam picks up what? 30 cents on a dollar, right? They can put that interest on my tax return, deduct it, and I am going to pay, right, less, aren't I? Everybody good? I don't have to pay the full amount. So it's 1 minus the tax rate. So that's what you read about. Does it make sense? So again, if this is 10%, I'm in a 30% tax bracket, it looks something like this. I get 7% there. Take the weight times the cost after tax cost of debt, right? You got it. One little piece more, okay? And we'll do the rest next time, obviously. What's the deal here? We'll go through it all again and work a real problem, work a problem. What do we use for KE? Yes, sir?
Can you go over real quick how you got 7%?
Okay, assuming my interest rate on my debt average is 10%, okay, I'm assuming that, okay, and I'm in a 30% tax bracket. Every dollar of interest I pay, I put it on my tax return, and it lowers my taxable income, which saves me 30 cents of taxes. So what did the interest really cost me? I paid $1 of interest, but I saved 30 cents in taxes. It cost me 70 cents. Everything's that way. Every single one of my expenses I put on my tax return, the government pays for part of it. Every dollar of revenue I put on my tax return, the government takes part of it, right? If I lowered my taxes, I didn't pay as much interest. You know what's really awful? A company that's losing money in a zero tax bracket, they have to pay the whole 10% interest. A company that's making money, they pay less. So companies that are making money have lower interest rates than companies that are losing money. Once you start losing money, you're really in trouble, right? Down the tubes. Okay, what do we use for KE? That's where this CAPM comes in. Capital Asset Pricing Model equals KE, cost of equity. What's that? Risk-free plus beta times the return on the market minus risk-free. We'll pick up there next time. That's what's going on. Figure out what these things are. What's the risk-free? 30-year treasury bond is what I like to use. Different people use different things. What's the beta? It's the covariance of your stock's returns relative to the returns of the market. Wow. Dividends and earnings and all that, okay? Increase in value. What this is, where you can find it is on Yahoo or MS Finance. You can just look it up. So go find the beta. This risk-free is the same risk-free as over here, right? Same one. So you're just using the risk-free, plus it's beta times the risk premium. It's the difference between these two, okay? What's the return on the market? What do you think the market is going to earn forever? 12, 13%, I don't know, whatever you think it is.
So market return is just a guess?
Yeah, yes, just a guess.
Really?
What's gonna
It's
happen?
just a guess?
Yeah. Well, yeah, in educated guess. Everything's a guess. Everything's a guess. Everything in
In
financial
this
statements.
particular equation, you just plug something in there, it's just a guess.
Well, yeah, but if you plug 2% in there, I think you're an insane person. You think the market's only going to earn 2% forever?
No.
I think the market's probably going to earn 11, 12, 13
Oh, you're off.
on average forever. No, forever.
Oh, okay.
The last 30 or 40 years, the market has earned 12 to 13% on average. What's that?
It's not according to the other side.
Oh, I thought you said I already said that, and I did right at the beginning. I said that.
The RP.
Risk free.
Yeah, that.
So go back and look at the paper again. Did you work that example problem yet, guys?
Tried to.
Okay, all right, good. We'll do that, and then we'll value real companies too.
Good mediation.
We got time on this. How many days do we have?
Two more.
2 more. Okay, we're good.
Sam? No, it's
See you guys. Try to get it conceptually, okay?
I don't know.
Mm-hmm.
All right.